In this video, we're going to talk about Camber Energy, trading under the ticker symbol CEI. At the moment, there's a lot of volatilities coming out of the financial market, and especially with the growth stocks. And we have to be careful about which titles to buy and which securities to unload. Today's video is going to cover the recent price action momentums and the technicals of CEI. Before the video begins, a quick heads up that my analysis is based on sessions already completed and that it may not take into consideration the latest events. If that is the case, I will then make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock increased to 68 cents before closing the trading day at 67 cents. We gotta pay attention to the 78 cents nearby because it was tested 2 times, both as a support and resistance, which is a significant level to watch out for. Over the past 30 days, the trend of the stock has been bullish because CEI clearly showed its will to break away from the recent market sell-off, bouncing from around 45 cents to around 85 cents, before retracing somewhat back to its original territories. From the perspective of a longer time frame, 6 months and above, the trend of the stock has been bearish because the stock has been on a continual sell-off since late 2021, although the recent price actions may suggest that it found a bottom where it currently is. When we look at the price trend overall, it has been slowing, probably because the market became oversold after it reached the 45 cents level and has decided to correct from there. We have to wait for additional confirmations to see, of course, if they will be able to hold above the 60 cents and hopefully going up from there. The trading volume of Camber Energy has recently been very good, at around 65 million shares versus the average volume of 41 million shares. Over the previous 52-week period, its price fluctuated between 33 cents and $4.85. The market cap of Camber Energy is currently at $159 million versus an enterprise value of $171 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, market conditions, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst the market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for growth stocks. One key element to note regarding the enterprise value is that for many growth type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have faster growth than other companies, partially because it has a good management, stronger brand recognition, bigger online following, and so on. It is basically what is unique about this company in particular versus an alternative. In other words, it's not a tangible asset to generate income, but it's often the reason why some companies are perceived to be trading at a discount when we compare the market cap to the enterprise value including the goodwill. The enterprise value is less reactive than the market cap in very volatile situations, and if the company goes to liquidation, there would be no goodwill, and the shareholders and bondholders would be left to distribute whatever that is left after all the depreciation and impairment, which is likely going to be a lot less than the current number on the balance sheet. When we compare the current price with the historical price fluctuations, the stock is 40% higher than the 1-month low, 40% higher than the 3-month low, and 40% higher than the 52-week low. On the options market, which gives a hint about the sentiment where the stock price is likely going to go next, the implied volatility is 198% versus a historical volatility of 134%. The put-call volume ratio is currently at 0.15. It is normal for some stocks to tend to have a higher put option volume than what they deserve because institutional investors systematically hedge their long positions by buying put options. The most recent volume of options traded has been 25,000 contracts a day, compared to the 30-day average of 21,000. For open interest, the most recent volume of open interest traded has been 159,000 contracts versus a 30-day average of 120,000 contracts. Regarding the shareholder structure, institutional shareholders own 22% of the outstanding shares. The biggest shareholders include Vanguard, Renaissance Technologies, and BlackRock. It is relevant to understand the shareholder composition of a company because it helps us to determine if the stock deserves to be held long-term or to be traded short-term. If the stock is mainly held by retail traders, this can potentially be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, there's a lot of exceptions since many great companies are also held by retail traders for the most part, but that tends to be the exception and not the rule so far. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes there are significant short interest in a total volume, and this could be a sign that something organized is going on. The current short interest is 12% of the total volume, and 50% of that come from the dark pools. Overall, my opinion on Camber Energy is to keep it on watch list because the company does have potential from a fundamental perspective. However, the recent price action does encourage us to be more careful before committing capital, thinking that it is low enough to reach a floor. But what we've come to realize is that sometimes that floor may not hold very long if the market dynamics are against it. And in this case, I would say that we have to see if the stock can hold at where it is right now for at least 1 to 2 weeks. The maximum exposure I would recommend is 1 to 3% of your portfolio. For the immediate term, my recommendation is to wait for better timing because we have to see some confirmations that the support levels have been reached and will be supported before going further. Regarding the batches of your allocation, I would recommend to separate it in 25% of the allocation at one time so that you can have enough room for later purchases. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors, With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.